Life insurance: what it is, how it works, and how to buy a policy. What is life insurance? Life insurance is a contract between a life insurance company and a policy owner. A life insurance policy guarantees the insurer pays a sum of money to one or more named beneficiaries when the insured person dies in exchange for premiums paid by the policyholder during their lifetime. Types of life insurance. Many different types of life insurance are available to meet all sorts of needs and preferences. Depending on the short or long-term needs of the person to be insured, the major choice of whether to select temporary or permanent life insurance is important to consider. Term life insurance. Term life insurance is designed to last a certain number of years, term versus permanent life insurance. Term life insurance differs from permanent life insurance in several ways but tends to best meet the needs of most people looking for affordable life insurance coverage. Term life insurance only lasts for a set period of time and pays a death benefit should the policyholder die before the term has expired. Permanent life insurance stays in effect as long as the policyholder pays the premium. Another critical difference involves premiums. Term life is generally much less expensive than permanent life because it does not involve building a cash value. Before you apply for life insurance, you should analyze your financial situation and determine how much money would be required to maintain your beneficiary's standard of living or meet the need for which you're purchasing a policy. Also, consider how long you'll need coverage for. For example, if you are the primary caretaker and have children 2 and 4 years old, you would want enough insurance to cover your custodial responsibilities until your children are grown up and able to support themselves. You might research the cost of hiring a nanny and a housekeeper or using commercial child care and cleaning services, then perhaps add money for education. Include any outstanding mortgage and retirement needs for your spouse in your life insurance calculation. Especially if the spouse earns significantly less or is a stay-at-home parent. Add up what these costs would be over the next 16 or so years, add more for inflation, and that's the death benefit you might want to buy, if you can afford it. Then end. You choose the term when you take out the policy. Common terms are 10, 20, or 30 years. The best term life insurance policies balance affordability with long-term financial strength. Decreasing term life insurance is renewable term life insurance with coverage decreasing over the life of the policy at a predetermined rate. Convertible term life insurance allows policyholders to convert a term policy to permanent insurance. Renewable term life insurance provides a quote for the year the policy is purchased. Premiums increase annually and are usually the least expensive term insurance in the beginning. Many term life insurance policies allow you to renew the contract on an annual basis once the term is up. This is one way to extend your life insurance coverage, but since the renewal rate is based on your current age, premiums can rise precipitously each year. A better solution for permanent coverage is to convert your term life insurance policy into a permanent policy. This is not an option on all term life policies. Look for a convertible term policy if this is important to you. Permanent life insurance. Permanent life insurance stays in force for the insured's entire life unless the policyholder stops paying the premiums or surrenders the policy. It's more expensive than term. Whole life insurance is a type of permanent life insurance. It accumulates a cash value in order to last the lifetime of the insured person. Cash value life insurance also allows the policyholder to use the cash value for many purposes, such as a source of loans or cash or to pay policy premiums. Universal life (UL) insurance is a type of permanent life insurance with a cash value component that earns interest. Universal life features flexible premiums. Unlike term and whole life, the premiums can be adjusted over time and designed with a level death benefit or an increasing death benefit. Indexed Universal Life (IUL) is a type of universal life insurance that lets the policyholder earn a fixed or equity-indexed rate of return on the cash value component. Variable Universal Life (VUL) insurance allows the policyholder to invest the policy's cash value in an available separate account. It also has flexible premiums and can be designed with a level death benefit or an increasing death benefit. What affects your life insurance premiums and costs? Many factors can affect the cost of life insurance premiums. Certain things may be beyond your control, but other criteria can be managed to potentially bring down the cost before, and even after, applying. Your health and age are the most important factors that determine cost, so buying life insurance as soon as you need it is often the best course of action. After being approved for an insurance policy, if your health has improved and you've made positive lifestyle changes, you can request to be considered for a change in risk class. Even if it is found that you're in poorer health than at the initial underwriting, your premiums will not go up. If you're found to be in better health, then your premiums may decrease. You may also be able to buy additional coverage at a lower rate than you initially did. Life Insurance Buying Guide. Step 1. Determine how much you need. Think about what expenses would need to be covered in the event of your death. Things like mortgage, college tuition, and other debts, not to mention funeral expenses. Plus, income replacement is a major factor if your spouse or loved ones need cash flow and are not able to provide it on their own. There are helpful tools online to calculate the lump sum that can satisfy any potential expenses that would need to be covered. Age. This is the most important factor because life expectancy is the biggest determinant of risk for the insurance company. Considerations before buying life insurance. Research policy options and company reviews. Because life insurance policies are a major expense and commitment, it's critical to do proper due diligence to make sure the company you choose has a solid track record and financial strength, given that your heirs may not receive any death benefit for many decades into the future. Investopedia has evaluated scores of companies that offer all different types of insurance and rated the best in numerous categories. Consider how much death benefit you need. Life insurance can be a prudent financial tool to hedge your bets and provide protection for your loved ones in case of death should you die while the policy is in force. However, there are situations in which it makes less sense, such as buying too much or insuring those whose income doesn't need to be replaced. So it's important to consider the following. What expenses couldn't be met if you died? If your spouse has a high income and you don't have any children, maybe it's not warranted. It is still essential to consider the impact of your potential death on a spouse and consider how much financial support they would need to grieve without worrying about returning to work before they're ready. However, if both spouses' income is necessary to maintain a desired lifestyle or meet financial commitments, then both spouses may need separate life insurance coverage. Know why you're buying life insurance. If you're buying a policy on another family member's life, it's important to ask, what are you trying to insure? Children and seniors really don't have any meaningful income to replace, but burial expenses may need to be covered in the event of their death. Beyond burial expenses, a parent may also want to protect their child's future insurability by purchasing a moderate-sized policy when they are young. Doing so allows that parent to ensure that their child can financially protect their future family. Parents are only allowed to purchase life insurance for their children up to 25% of the in-force policy on their own lives. Could investing the money that would be paid in premiums for permanent insurance throughout a policy earn a better return over time? As a hedge against uncertainty, consistent saving and investing, for example, self-insuring, might make more sense in some cases if a significant income doesn't need to be replaced or if policy investment returns on cash value are overly conservative. How life insurance works. A life insurance policy has two main components, a death benefit and a premium. Term life insurance has these two components, but permanent or whole life insurance policies also have a cash value component. 1. Death benefit. The death benefit or face value is the amount of money the insurance company guarantees to the beneficiaries identified in the policy when the insured dies. The insured might be a parent, and the beneficiaries might be their children, for example. The insured will choose the desired death benefit amount based on the beneficiary's estimated future needs. The insurance company will determine whether there is an insurable interest and if the proposed insured qualifies for the coverage based on the company's underwriting requirements related to age, health, and any hazardous activities in which the proposed insured participates. 32. Premium. Premiums are the money the policyholder pays for insurance. The insurer must pay the death benefit when the insured dies if the policyholder pays the premiums as required, and premiums are determined in part by how likely it is that the insurer will have to pay the policy's death benefit based on the insured's life expectancy. Factors that influence life expectancy include the insured's age, gender, medical history, occupational hazards, and high-risk hobbies. 3. Part of the premium also goes toward the insurance company's operating expenses. Premiums are higher on policies with larger death benefits, individuals who are at higher risk, and permanent policies that accumulate cash value. 3. Cash value. The cash value of permanent life insurance serves two purposes. It is a savings account that the policyholder can use during the life of the insured. The cash accumulates on a tax-deferred basis. Some policies may have restrictions on withdrawals depending on how the money is to be used. For example, the policyholder might take out a loan against the policy's cash value and have to pay interest on the loan principal. The policyholder can also use the cash value to pay premiums or purchase additional insurance. The cash value is a living benefit that remains with the insurance company when the insured dies. Any outstanding loans against the cash value will reduce the policy's death benefit. Gender. Because women statistically live longer, they generally pay lower rates than males of the same age. Smoking. A person who smokes is at risk for many health issues that could shorten life and increase risk-based premiums. Health. Medical exams for most policies include screening for health conditions like heart disease, diabetes, and cancer and related medical metrics that can indicate risk. Lifestyle. Dangerous lifestyles can make premiums much more expensive. Family medical history. If you have evidence of major disease in your immediate family, your risk of developing certain conditions is much higher. Driving record. A history of moving violations or drunk driving can dramatically increase the cost of insurance premiums. Standard forms of identification will also be needed before a policy can be written, such as your Social Security card, driver's license, or U.S. passport. Step 3. Compare policy quotes. When you've assembled all of your necessary information, you can gather multiple life insurance quotes from different providers based on your research. Prices can differ markedly from company to company, so it's important to take the effort to find the best combination of policy, company rating, and premium cost. Because life insurance is something you will likely pay monthly for decades, it can save an enormous amount of money to find the best policy to fit your needs. Benefits of life insurance. There are many benefits to having life insurance. Below are some of the most important features and protections offered by life insurance policies. Most people use life insurance to provide money to beneficiaries who would suffer a financial hardship upon the insured's death. However, for wealthy individuals, the tax advantages of life insurance, including the tax-deferred growth of cash value, tax-free dividends, and tax-free death benefits, can provide additional strategic opportunities. Avoiding taxes. The death benefit of a life insurance policy is usually tax-free. 1. Wealthy individuals sometimes buy permanent life insurance within a trust to pay estate taxes. This strategy helps to preserve the value of the estate for their heirs. Tax avoidance is a law-abiding strategy for minimizing one's tax liability and should not be confused with tax evasion, which is illegal. Who needs life insurance? Life insurance provides financial support to surviving dependents or other beneficiaries after the death of an insured policyholder. Here are some examples of people who may need life insurance. Parents with minor children. If a parent dies, the loss of their income or caregiving skills could create a financial hardship. Life insurance can make sure the kids will have the financial resources they need until they can support themselves. Parents with special needs adult children. For children who require lifelong care and will never be self-sufficient, life insurance can make sure their needs will be met after their parents pass away. The death benefit can be used to fund a special needs trust that a fiduciary will manage for the adult child's benefit. Point 2. Adults who own property together. Married or not, if the death of one adult would mean that the other could no longer afford loan payments, upkeep, and taxes on the property, life insurance may be a good idea. One example would be an engaged couple who take out a joint mortgage to buy their first house. Seniors who want to leave money to adult children who provide their care. Many adult children sacrifice time at work to care for an elderly parent who needs help. This help may also include direct financial support. Life insurance can help reimburse the adult child's costs when the parent passes away. Young adults whose parents incurred private student loan debt or co-signed a loan for them. Young adults without dependents rarely need life insurance, but if a parent will be on the hook for a child's debt after their death, the child may want to carry enough life insurance to pay off that debt. Children or young adults who want to lock in low rates. The younger and healthier you are, the lower your insurance premiums. A 20-something adult might buy a policy even without having dependents if there is an expectation to have them in the future. Stay-at-home spouses. Stay-at-home spouses should have life insurance as they have significant economic value based on the work they do in the home. According to Salary.com, the economic value of a stay-at-home parent would have been equivalent to an annual salary of $162,581 in 2018. Wealthy families who expect to owe estate taxes. Life insurance can provide funds to cover the taxes and keep the full value of the estate intact. Families who can't afford burial and funeral expenses. A small life insurance policy can provide funds to honor a loved one's passing. Businesses with key employees. If the death of a key employee, such as a CEO, would create a severe financial hardship for a firm, that firm may have an insurable interest that will allow it to purchase a life insurance policy on that employee. Married pensioners. Instead of choosing between a pension payout that offers a spousal benefit and one that doesn't, pensioners can choose to accept their full pension and use some of the money to buy life insurance to benefit their spouse. This strategy is called pension maximization. Those with pre-existing conditions, such as cancer, diabetes, or smoking. Note, however, that some insurers may deny coverage for such individuals, or else charge very high rates. Step 2. Prepare your application. Life insurance applications generally require personal and family medical history and beneficiary information. You may need to take a medical exam and will need to disclose any pre-existing medical conditions, history of moving violations, DUIs, and any dangerous hobbies, such as auto racing or skydiving. The following are crucial elements of most life insurance applications. Life insurance riders and policy changes. Many insurance companies offer policyholders the option to customize their policies to accommodate their needs. Riders are the most common way policyholders may modify or change their plans. There are many riders, but availability depends on the provider. The policyholder will typically pay an additional premium for each rider or a fee to exercise the rider, though some policies include certain riders in their base premium. The accidental death benefit rider provides additional life insurance coverage in the event the insured's death is accidental. The waiver of premium rider relieves the policyholder of making premium payments if the insured becomes disabled and unable to work. The disability income rider pays a monthly income in the event the policyholder becomes unable to work for several months or longer due to a serious illness or injury. Upon diagnosis of terminal illness, the accelerated death benefit rider allows the insured to collect a portion or all of the death benefit. The long-term care rider is a type of accelerated death benefit that can be used to pay for nursing home, assisted living, or in-home care when the insured requires help with activities of daily living, such as bathing, eating, and using the toilet. A guaranteed insurability rider lets the policyholder buy additional insurance at a later date without a medical review. Borrowing money. Most permanent life insurance accumulates cash value that the policyholder can borrow against. Technically, you are borrowing money from the insurance company and using your cash value as collateral. Unlike with other types of loans, the policyholder's credit score is not a factor. Repayment terms can be flexible, and the loan interest goes back into the policyholder's cash value account. Policy loans can reduce the policy's death benefit, however. Funding retirement. Policies with a cash value or investment component can provide a source of retirement income. This opportunity can come with high fees and a lower death benefit, so it may only be a good option for individuals who have maxed out other tax-advantaged savings and investment accounts. The pension maximization strategy described earlier is another way life insurance can fund retirement. Qualifying for life insurance. Insurers evaluate each life insurance applicant on a case-by-case basis, and with hundreds of insurers to choose from, almost anyone can find an affordable policy that at least partially meets their needs. In 2018 there were 841 life insurance and annuity companies in the United States, according to the Insurance Information Institute. Point 4. On top of that, many life insurance companies sell multiple types and sizes of policies, and some specialize in meeting specific needs, such as policies for people with chronic health conditions. There are also brokers who specialize in life insurance and know what different companies offer. Applicants can work with a broker free of charge to find the insurance they need. This means that almost anyone can get some type of life insurance policy if they look hard enough and are willing to pay a high enough price or accept a perhaps less than ideal death benefit. Insurance is not just for the healthy and wealthy, and because the insurance industry is much broader than many consumers realize, getting life insurance may be possible and affordable even if previous applications have been denied or quotes have been unaffordable. In general, the younger and healthier you are, the easier it will be to qualify for life insurance, and the older and less healthy you are, the harder it will be. Certain lifestyle choices, such as using tobacco or engaging in risky hobbies such as skydiving, also make it harder to qualify or lead to higher rates. Who needs life insurance? You need life insurance if you need to provide security for a spouse, children, or other family members in the event of your death. Life insurance death benefits, depending on the policy amount, can help beneficiaries pay off a mortgage, cover college tuition, or help fund retirement. Permanent life insurance also features a cash value component that builds over time. What affects your life insurance premiums? Age, life insurance is less expensive. Gender, female tends to be less expensive. Smoking increases premiums. Health, poor health can raise premiums. Lifestyle, risky activities can increase premiums. Family medical history, chronic illness in relatives can raise premiums. Driving record, good drivers save on premiums. What are the benefits of life insurance? Payouts are tax-free. Life insurance death benefits are paid as a lump sum and are not subject to federal income tax because they are not considered income for beneficiaries. Dependents don't have to worry about living expenses. Most policy calculators recommend a multiple of your gross income equal to 7 to 10 years that can cover major expenses like mortgages and college tuition without the surviving spouse or children having to take out loans. Final expenses can be covered. Funeral expenses can be significant and can be avoided with a burial policy or with standard term or permanent life policies. Policies can supplement retirement savings. Permanent life policies such as whole, universal, and variable life insurance can offer cash value in addition to death benefits, which can augment other savings in retirement. How do you qualify for life insurance? To qualify for life insurance, you need to submit an application. But life insurance is available to almost anyone. However, the cost or premium level can vary greatly based on your age, health, and lifestyle. Some types of life insurance don't require medical information but generally have much higher premiums and involve an initial waiting period before the death benefit is available. How does life insurance work? Life insurance works by providing a death benefit in exchange for paying premiums. One popular type of life insurance, term life insurance, only lasts for a set amount of time, such as 10 or 20 years. Permanent life insurance also features a death benefit but lasts for the life of the policyholder as long as premiums are paid. Life insurance is a contract between an insurance policyholder and an insurer, where the insurer promises to pay a sum of money to the beneficiary when the insured person dies or after a predetermined period in exchange for the premiums paid by policyholder. In life insurance policy you need to pay premiums for a specified policy term and life insurance company provides you with a comprehensive life cover, in return. Life insurance protects future of your loved by paying a lump sum amount referred to as death benefit if an unfortunate event occurs. Some life insurance policies provide you a maturity benefit after the end of the policy term. Lack of awareness is one of the major impediments for widespread adoption of life insurance. The availability of different types of insurance products also confuses some people. But most life insurance policies function in a similar manner. Let us understand what is life insurance and how does it work. Life insurance policy meaning. Life insurance is defined as a legally binding contract between a policyholder and an insurer in which the insurance company provides financial protection to the policyholder and pays a death benefit to the nominee when the insured dies. For a life insurance policy to remain in force, the policyholder must pay regular premiums over the period of time or pay a single premium upfront. In a nutshell, all the benefits of a life insurance policy are tied to the payment of premiums, which is why one should opt for a premium that can be easily serviced. A life insurance policy works only if the policyholder has paid all premiums regularly. As you have understood the meaning of life insurance policy, you will find it easier to know how life insurance works. How does a life insurance policy work? Life insurance is a legal contract where you pay a small sum as a premium for insuring a large protective sum. The insurer will make the large sum available to your family and dependents in the case of your untimely demise. Usually, the life insurance is available for a limited period. Thus, if your death occurs within this period, the life insurer is bound to pay a death benefit, which is also called sum assured. However, in the case of your surviving the term, you may receive a maturity benefit depending on the type of life insurance. Whole life insurance plans, however, are more likely to pay the death benefit than maturity benefit. Let's understand this with an example. Mr. Shah bought a life insurance policy from Canara HSBC Life Insurance. The 20-year policy has a sum assured of 10 rupees lakhs and an annual premium of 25,000 rupees payable for 20 years, i.e., premium payment term equals policy term. The sum assured of the policy is also payable as maturity benefit if Mr. Shah completes the policy term. Here's how this life insurance policy will work for Mr. Shah. Mr. Shah completes the policy term 1. He has paid a total of 5 rupees lakhs as premiums for the life cover. 2. He will receive maturity benefit of 10 rupees lakhs plus any bonus, if applicable. 3. Policy will terminate after paying the maturity benefit. Mr. Shah dies in the 10th policy year 1. He has paid a total of 2.5 rupees lakhs in premiums for the life cover. 2. His nominees will receive a total of 10 rupees lakhs plus any bonus, if applicable, in the 10th policy year. 3. Policy will terminate after paying the death benefit if Mr. Shah opted for premium protection in the policy. Upon his death in the 10th year the policy will 1. Pay the death benefit, 10 lakhs only, as usual to his family in the 10th policy year. 2. Continue to accumulate investment value. 3. Will pay the promised maturity value of 10 rupees lakhs plus any bonus, if applicable, at the end of 20-year policy term benefits of life insurance plans. Life insurance plans are long-term investment and protection plans with several benefits. A few of the most prominent benefits of life insurance plans are: 1. Financial protection. A major benefit of any life insurance plan is that it provides financial security to your family members. Life insurance policies include a death benefit. If you die during the term of the policy, then a predefined amount, known as the sum assured, is given to your family members. This ensures that your family members are financially secured even after you are not present with them. 2. Build saving habit. To keep your life insurance policy active, you are required to pay regular amounts known as premiums. Without the payment of premiums, your policy can get cancelled. Thus, by investing regularly, you inculcate a habit of savings which benefits you in the long run. 3. Helps in tax savings. To promote savings and investment, the government has made many investment instruments eligible for tax savings. Life insurance is one such instrument. You can avail of a tax deduction of up to 1.5 rupees lakh towards the premium you pay in a year U/S80C of the Income Tax Act 1961. Thus, you have the benefit of investment as well as tax savings. 4. Achieve your big financial goals. Some life insurance policies build a cash value over time. Life insurance policies such as ULIP have an investment component as well. Your premium is invested in marketable securities and earns a return. With time they build into a large corpus that can be used to achieve goals such as your child's education, child marriage, etc. 5. Wealth protection and distribution. Life insurance plans are one of the safest long-term investment options. Thus, a life insurance will mean you can preserve your wealth for a long time against tax and inflation. This feature means that a life insurance plan is also a great instrument for retired investors to generate long-term pension. Different types of life insurance plans in India. Now that you know what is a life insurance policy, let us understand how many types of life insurance policies are available. Life insurance plans are based on your discretion. There are various types of life insurance policies that you can choose from. Remember that it is important to consider your financial goals when you are planning to buy the best life insurance plan. Listed below are the different types of life insurance plans that are available. 1. Term life insurance plan. Term insurance is the most popular one in life insurance category. It has a specific period and expires at the end of the term. The best things about a term plan are the premiums are quite affordable. These plans can be bought by people who have just started their career as the premiums are low. Some of the best term life insurance plans offer critical or terminal illness cover. That means the policyholder will be paid a lump sum amount on diagnosis of life-threatening diseases to help them cover the medical expenses. Learn more about term insurance plans. 2. Whole life insurance plan. As the name suggests, it is a policy that covers you till you turn 99. That means, you can be protected till you are 99 years of age. Whole life insurance plans have a death benefit along with cash value. The life insurance policy's cash value will grow over time and can be withdrawn by the policyholder when it accumulates enough value. Or, it can also be withdrawn if the policyholder opts for a loan on the life insurance policy. 3. Unit-linked insurance plans. ULIPs are investment plus insurance plans so that you can enjoy best of both the worlds. This is a type of life insurance policy that offers life cover along with investment opportunities. Most of the ULIPs have a lock-in period of 5 years, hence, it can be considered as a long-term investment plan. It functions as per market dynamics and you should understand your risk appetite before buying a ULIP. 4. Endowment/saving plans. This is a type of life insurance policy that offers you a life cover along with an avenue for savings. If you buy the best saving plan, you can save regularly over a period and this will lead you to get a lump sum amount at maturity. Buying an endowment or saving plan is beneficial if you have long-term financial goals such as funding your child's education, buying a new house, or spending a carefree retirement life. 5. Money-back policy. Money-back policy is a type of life insurance policy that gives money back at regular intervals. A percentage of the sum assured is paid back at intervals during the policy tenure. These life insurance plans offer survival benefits, which are paid out during the plan tenure and at maturity. If the policyholder passes away when the policy is in force, the entire sum assured is paid to the beneficiaries irrespective of the survival benefits already paid. 6. Child insurance plan. Child insurance plans are life insurance policies that are opted to safeguard the future of your child. Along with providing a life cover, it helps in building an education fund to support your child's dreams and aspirations. Child plans are investment plus insurance plans designed to assist you in creating wealth for your child's future needs. You can invest in these plans right when your kid is born to build a strong financial cover. 7. Retirement plans. These life insurance policies help you build a retirement corpus so that you can enjoy your post-retirement life. You can make your spouse the beneficiary to your life insurance plan. So, in case something happens to you, they can be financially independent. Also, having the best life insurance plan will help you pay for medical expenses during retirement. Learn how to plan for medical expenses during retirement. How to buy life insurance policy online. Now that you know what is a life insurance policy and how it works, let us move to the buying process. Buying a life insurance policy has got simpler with time, thanks to the online channels that allow purchasing a policy easily, without any hassles. Applying for a life insurance plan is easy in India. You can either contact the nearest branch of an insurance company, or you can buy a life insurance plan online. Canara HSBC Life Insurance has optimized its procedure by taking it online. You can ditch the unnecessary paperwork and choose the convenience of buying a life insurance plan from the comfort of your home. Life insurance companies conduct a verification of all the details provided by the buyer before issuing a policy. One has to fill out an application form with details like medical history and family health history. The insurer may even ask you to undergo a medical examination, if required. Earlier, life insurance policies could be purchased only offline via an agent. But advancements in technology have made it possible for you to buy insurance online with just a few clicks. Here are the steps you can follow to buy your insurance online. 1. Log into the site, https://www.canarahsbclife.com/index.html https://www.canarahsbclife.com/index.html 2. You will be provided with all the life insurance options available. 3. Calculate your premium by clicking on the Check Premium button. After entering the details, you will be given an estimated premium. 4. Move forward and enter your basic details in the application form provided. 5. Undergo medical tests, if asked. 6. Based on the information entered, the premium is given. 7. Pay your premium from the various online modes available. You can pay via credit card, debit card, net banking, etc. 8. After the verification of details, the policy will be issued to you. How to choose the right type of life insurance policy. Only understanding what is a life insurance policy is not enough. You must know what type of life insurance policy will be suitable for your needs. In addition to the amount of coverage you need, you should also figure out what type plan you need. Of all the types of life insurance plans available, there are two major questions that will help you determine the right policy. 1. How long you want your life insurance coverage to last. 2. What goal do you wish to prioritize and save for? Answer these questions and find a life insurance plan that suits your needs. For example, if you want a life cover where you can add your spouse too, then look for insurance plans that offer such. Benefits. iSelect Star Term Plan allows you to add your spouse in the same life insurance policy at discounted rates. Secure their financial future by helping them get a life cover. How to claim life insurance after death of the policyholder. In the event of an untimely death of the insured, the insurance company pays the sum assured to the nominee. The claims process is very simple. The insurance company has to be informed as soon as possible after the death of the insured. The nominee has to fill a claims form and submit with required documents like death certificate. The insurance company verifies the claim and releases the benefit. In some cases, the insurance company may choose to examine the claim. You will have to provide additional documents and the claim settlement will take slightly more time. Claims can be paid out in a lump sum or in regular monthly installments. You can choose the way you want the nominees to receive the death benefit. If the policyholder passes away, as a beneficiary of the plan, you can follow these 3 steps to file a claim. 1. Death certificate. You will be asked to submit a copy of the death certificate of the policyholder when you start the claim process. The life insurance company may need a certified copy, hence, you must keep this document handy, if you do not want to delay the process. 2. Contact the insurer. Contact the life insurance company and inform them. Although, when a loved one passes away, we have a lot on our plates to deal with. However, the sooner you start the entire process, the better it is. 3. Documentation. The life insurance company may need a lot of other documents such as claim form. Ensure that all the necessary documents are ready with you before you start the claim process. Life insurance policies are a guarantee for your loved ones. Buying the best life insurance policy can help in providing financial assistance to your family in an unfortunate event. This covers accidental death, permanent and temporary disability, and child support. You need a life insurance plan if A. You are married. B. You have children. C. You are unmarried. Whether you are single, married or have kids, you need a life insurance plan to stay protected. If your family relies on you for financial support, it is better you consider buying the best life insurance plan. The cost of education is spiraling and building an education fund right from the beginning is the only solution if you want to secure their future. Also, even if you are single, unexpected expenses may pop up anytime, catching you completely off guard. How much life insurance cover do I need? Life insurance cover depends on your beneficiary's monthly income and expenses. You need to evaluate your liabilities and assess your financial goals. It requires a thorough self-assessment of retirement corpus and life goals. However, experts suggest that you should always buy a life cover at least 10 times of your income. You can be assured that you have adequate life cover for you and the beneficiaries. Not buying the right policy cover may put you in a fix. You do not need to pay premiums beyond your budget. Analyze your existing financial circumstances and calculate the premium before making any decisions. How much does a life insurance plan cost in India? The actual cost of buying a life insurance policy depends on the following few factors. 1. Life cover amount. 2. Your current age. 3. Lifestyle and habits. 4. Current and history of physical health. 5. Family health history. 6. Policy tenure you are intending to choose. Is buying a life insurance policy worth it? A life insurance policy aims to protect your family. In simple terms, the death benefit received by the nominees replaces the financial assistance you provided to your dependents. In the wake of the pandemic, more people are scrambling to buy the best life insurance. Because of the financial security it provides, buying a life insurance plan is worth it. In a way, this smart financial tool must be an integral part of financial planning. Your family will be financially savvy in case something happens to you. If you protect your loved ones with the promise of a life insurance plan, you can be assured of fulfilling all the promises you had made to them, even if you are not around. And Canara HSBC Life Insurance will always keep Aapki Vaad Sar Ankon Par. Listed below are our top life insurance plans that you consider. 1. Guaranteed Income for Life Plan. Guaranteed Income for Life, as the name suggests, this life insurance plan guarantees regular income along with providing a life cover. It is a highly customizable plan that offers flexibilities in terms of premium payment options and increasing life cover. The plan has 3 different variants to suit your financial requirements and goals. Whether it is lifelong protection for you and your spouse or fulfilling your child's education needs, preparing you for early retirement or giving you that extra income to make sure every promise is fulfilled, Guaranteed Income for Life has it all covered. 2. Guaranteed Savings Plan. It is a guaranteed income plan which ensures that you get a guaranteed maturity benefit. The premiums to be paid are high, but you receive a better value in return. The GSP covers for the entire life term even though you pay premiums for a limited time. Customize your savings horizon as align them accordingly with your financial goals to meet your milestones. Whether you are planning to build an education fund for your child's future, or you want to save for your child's marriage, or you want to retire and lead a happy life, this savings plan may help you achieve your life goals. 3. iSelect Star Term Plan. iSelect Star Term Plan is a life insurance plan that offers a limited premium payment option. It is tailored to suit the Indian market as it is budget-friendly. The plan offers the option of adding the spouse, thereby adding a discount for the spouse. Also, it has a return of premium option. That means, if the policyholder outlives the policy term and has paid all the premiums, then the premiums will be paid back at maturity. This is a win-win. The plan also offers a variety of riders that you can add for enhanced protection. Life insurance is a legally binding contract between you and your insurance company. In exchange for monthly or annual premiums, your insurance company gives your designated beneficiaries a lump sum payment, also known as a death benefit, upon your passing. You can get life insurance online or through an agent. Keep in mind your financial situation and long-term needs when choosing the amount and length of coverage on your policy. Note that there are 2 major types of life insurance policies, term and permanent. Term life insurance typically provides coverage for 10, 20, or 30 years, whereas a permanent policy lasts for your entire lifetime. Term life insurance is the more affordable option, but if you pass away after your term is up, your beneficiary will not receive a payout. When should I get life insurance? Many people choose to buy life insurance when they have kids or take out a mortgage. But any time your financial needs change, it's best to consider taking out a life policy. Consider these scenarios. Mortgage payoff. Think about how many years of mortgage payments you have left. It's best to get a policy for at least that number of years and the amount left on your mortgage. Children at home. How long will it be before your kids will be on their own? Consider the total cost to support them. Children's college costs. Think about how long it will be until your last child completes public or private school and college, and determine what you think the total cost will be. Partner who relies on your income. You may want a policy that offers a financial means for your loved one to maintain your current, or comparable, lifestyle. Think about what their total expenses will be until they retire. Inheritance. If you're considering leaving an inheritance, you may want a policy that lasts for the remainder of your life, a permanent life insurance policy. Funeral expenses. If you only need to cover funeral and burial costs, you can simply get a final expense life policy. Final expense is usually more affordable than other types of life insurance and can last for a set number of years or your lifetime. Explore more details on how much life insurance you need. Or, simply get a life insurance quote online to compare prices. Can you get life insurance with a pre-existing condition? You're not automatically disqualified from getting life insurance if you have a pre-existing condition. For example, if you have diabetes, elevated cholesterol, or blood pressure issues, an insurance company may simply evaluate these conditions differently when assessing your overall health risk. Here are a few common questions an insurer might ask to help determine the type and amount of life insurance they'll offer. Is your condition under control? Do you take medication to manage your condition? Do you see your doctor regularly? Have you had a recent health issue that caused you to see a doctor, get additional testing, or receive treatment? What impacts your life insurance price? Age and sex are two of the biggest factors that affect the cost of life insurance, but there are several other things insurers consider when determining your rate. For instance, if you have a job or hobby that's considered risky, you may pay more to offset the risk of insuring you. Other common factors include your overall health, financial history, and whether you use tobacco products. Learn more about the cost of life insurance. Different types of life insurance policies. Term life. Term life is the most affordable option and only lasts for a set number of years, typically from 10 to 30 years, though there's a 1-year short-term life insurance option too. If you pass away after the term length, your beneficiaries will not receive a payout. Many people choose term life to help pay off a specific expense, such as a mortgage or college tuition. See more on term life insurance. Permanent life. Permanent life lasts your entire lifetime and pays out no matter what age you are when you pass away, if you keep paying your premium. There are a few different types of permanent life that may allow you to withdraw funds early or change your payout amount over time. Many people choose permanent life if they plan to leave an inheritance to loved ones. See more on permanent life insurance. Final expense. Final expense insurance is more affordable than permanent life. It's designed for end-of-life expenses, such as funeral and burial costs, medical bills, credit card debt, and other expenses. Those whose finances are in order, but who worry about burdening family members with outstanding bills or funeral costs, often select this type of coverage. See more on final expense life insurance. Not sure which policy type is right for you? Check out our breakdown of the different types of life insurance. Life insurance can be essential for protecting your family financially in case of a tragedy, but many people go without it. In fact, nearly half of American adults do not have life insurance, according to a 2021 survey. 1 reason is that people assume life insurance is too expensive. For example, when asked to estimate the cost of a $250,000 term life policy for a healthy 30-year-old, the majority of survey respondents guessed $1,000 per year or more. In actuality, the average cost is closer to $160 a year. 5 Top Benefits of Life Insurance. Life insurance provides a number of useful benefits. Among them, 1. Life insurance payouts are tax-free. If you have a life insurance policy and die while your coverage is in effect, your beneficiaries will receive a lump sum death benefit. Life insurance payouts aren't considered income for tax purposes, and your beneficiaries don't have to report the money when they file their tax returns. Point 3. 2. Your dependents won't have to worry about living expenses. Many experts recommend having life insurance that's equal to 7 to 10 times your annual income. If you have a policy, or policies, of that size, the people who depend on your income shouldn't have to worry about their living expenses or other major costs. For example, your insurance policy could cover the cost of your children's college education, and they won't need to take out student loans. 3. Life insurance can cover final expenses. The national median cost of a funeral that included a viewing and a burial was $7,848 as of 2021.4 because many Americans do not have enough savings to cover even a $400 emergency expense. Having to pay for a funeral can be a substantial financial burden. Point 5. If you have a life insurance policy, your beneficiaries can use the money to pay for your burial expenses without having to dip into their own savings or use credit. Some insurers offer final expense policies. These policies have low coverage amounts and relatively inexpensive monthly premiums. 4. You can get coverage for chronic and terminal illnesses. Many life insurance companies offer endorsements, also known as riders, that you can add to your policy to enhance or adjust your coverage. An accelerated benefits rider allows you to access some or all of your death benefit under certain circumstances. Under some policies, for example, if you are diagnosed with a terminal illness and are expected to live less than 12 months, you can use your death benefit while you're still living to pay for your care or other expenses. 5. Policies can supplement your retirement savings. If you purchase a whole, universal, or variable life insurance policy, it can accumulate cash value in addition to providing death benefits. As the cash value builds up over time, you can use it to cover expenses, such as buying a car or making a down payment on a home. You can also tap into it if you need to during your retirement years. Point 6. However, a life insurance policy should not replace traditional retirement accounts like a 401k or an IRA. What's more, cash value life insurance is considerably more expensive than term life insurance, which has no savings component but simply a death benefit. The bottom line: life insurance isn't just for the wealthy. No matter your income level, life insurance can ensure that your loved ones could make ends meet if you were to pass away. And, life insurance might be more affordable than you think. If you decide to get coverage, check out Investopedia's list of the best life insurance companies of 2022.